let's just start then with costing methods. This means we want to talk about, well, you have read already chapter, absorption and variable costing. What are the advantages of variable costing? Variable costing, it helps you a lot to apply the cost volume profit um, analysis. I mean, the model could be easily applied because you have already separated um, all the expenses in a variable and in a fixed part using a contribution format income statement. Okay, you haven't noticed till now, but we have used this kind of costing pretty far, right? And you will see that you are pretty much familiarized with this kind of income statement. Okay, under variable costing, the profit of a period is not affected by changes in inventory. Other things remain the same. I mean, selling price, cost, sales mix, etc. Profit move in the same direction as sales do, because under variable costing we never apply cost of production that derives of variable expenses and costs into the products. Okay, managers often assume that product costs are variable, and it happens only if you are under variable costing. Remember our example of the pizza. The people believe that you have a gain when you have subtracted the selling price minus the variable expenses or cost, and it's not, by the way, right? Remember, you haven't subtracted the fixed expenses yet, so in order to avoid assuming that way, okay, we want to work on variable costing. Another thing is that the impact of fixed cost in profits is emphasized, highlighting the whole amount that must be coverable for the company to be truly profitable. So it's easier to establish profitability. I mean, if remember our formulas of contribution margin as a total, remember if the contribution margin as a total is not big enough to cover all the fixed expenses, you are in a loss. And in the other way around, if you have less fixed expenses than the total contribution margin, then you have a profit. So you may see it in a glance if you are profitable or not. Okay, so those are the advantages of variable costing. So we are facing two approaches. The only difference between one method and the other one is how do you determine the cost of the product that you are manufacturing. Under absorption costing, that is the cost that you have learned until now in your previous courses of accounting. The second one that was cost management, I think. Yeah, you learned that the cost of a product depends pretty much of direct materials, direct labor, variable manufacturing overhead, and fixed manufacturing overhead. Okay, so the costing that we have used until now is based on absorption costing, okay? But in variable costing, you only, okay, assigned to the product cost the part that it's variable, because remember, always for planning, you need to separate the part that is fixed and the part that is variable. So you cannot include in the cost of the product any element that has the behavior as a fixed expense, like in this case is the fixed manufacturer overhead. So in the variable costing, the fixed manufacturing overhead is treated as a period expense. I mean, like the salaries of administrative people, like the rent, like the energy, like all the expenses that belongs to a month, for example. I mean, the rent of the office of January. No matter how much you produce, this whole expense goes to the income statement because it's a period cost. Depends only to be in March. In the same way, if you have the rent for April, that is the period to be affected, only April. In the other way around, when you have cost of a product, depends on how the product travels, right, from the inventory to the income statement to affect the net income, okay? So in this specific case, the only difference is that, remember, on variable costing, we never accept in the upper part, I mean above the contribution, the total contribution margin, nothing that could be fixed, right? And below we have only fixed expenses. So fixed manufacturing overhead are expenses and costs related to manufacturing but not traced or identified to a single product. That's the meaning of manufacturing overhead. And from manufacturing overhead, um, examples we have, one that is really common is depreciation of the machinery. Depreciation of the machinery is a cost that you know that is manufacturing, and if it's calculated in a straight line, no matter how much you produce, you have a fixed cost, right? And you cannot trace that cost of depreciation to a single product. I mean, you never assigned a depreciation of product number 1, product number 3, product number 20, right? You don't have, so you have a total amount and then you assign to a single product using other formulas that we want to see later on, okay? So that's the definition of fixed manufacturing overhead, right? And as the same way we have variable manufacturing overhead. A variable manufacturing overhead could be maybe electric energy, right? If you are producing more, you're gonna pay more energy, but you cannot identify or trace the total cost of energy of one product that you have created or manufactured in one period, okay? That's the difference. Let's take an overview. For absorption costing, all manufacturing costs are product costs, regardless whether they're variable or fixed. This is the usual approach that we have used. This is also called full cost. It means everything needed for manufacturing a thing, I mean for translating direct materials into a finished good, is considered a cost. Then in absorption costing, goes in the cost of the unit cost of that product, okay? Under variable costing, only those manufacturing costs that vary with output are treated as a cost. That is also called direct or marginal costing. We have heard maybe direct costing, and direct costing is the same. It's only variable costs included into the product. So in this way, under absorption costing, we have that the cost is determined by adding the direct material, the direct labor, right? The variable manufacturing overhead and the fixed manufacturing overhead. I mean, if this is the box of your product, this box of your product travels with this cost, okay, all together. And under variable costing, your product travels in your accounting books only by adding the direct material, the direct labor, as well as the variable manufacturing overhead. Remember, on variable costing, no is no any cost that is fixed is not accepted. Okay, so under variable costing, under absorption costing, you have a cost that in here is, if I remember well, let's add those together. This is 20, 40, 54, right? The absorption costing in here and absorption costing will be 54, and on variable costing we will be only minus 12 is going to be 42. Okay, always guys, always in absorption costing, as you have one more element than on variable costing, your cost per unit is higher all the time. Okay, it doesn't mean that the cost of goods sold will be higher, but it means that per unit on absorption costing, every product compare the same product with variable costing will be higher only because it's included in the fixed manufacturing overhead. Okay, this is how it flows, how the situation flows. Okay, you buy at the beginning, start right here for raw material purchases. You start your process of production by getting raw materials from your suppliers. You send the raw materials, okay, into the raw material inventory. This is pretty much on the balance sheet. Okay, Direct material travels to the production line, okay, to be considered work in process inventory. You add to those raw material or direct material, that is the same thing, the direct labor in order to transform the thing, and you add the variable manufacturing overhead, remember, under variable, to have the working process inventory. But if you are working under absorption costing, you also add the fixed manufacturing overhead to the working process inventory. Remember that I told you that always, always, always under absorption costing, your inventory that gathers all the units that you have produced or you are producing in that exact time is higher than the cost under variable method, because you haven't on variable included the fixed manufacturing overhead. Then what happened with fixed manufacturing overhead? It doesn't mean that you don't have that expense. It doesn't mean that you don't depreciate the machinery or you don't pay salaries for quality assurance, let's say. It means that everything called fixed, no matter that this used for processing the raw material into finished goods, it goes directly to the income statement, considered as an expense of the period, known as a product cost. Okay, then you finish the process and you consider that the finished goods of the inventory. Then when you have finished goods of inventory of finished goods on the variable costing, the cost will be lower, right, than all the same units that you have under absorption costing. Okay, then you have as well another period cost. Okay, there are selling and administrative expenses that goes like the example I gave you about the rent of the offices, right? It means that goes to the period that is the income statement of August. Let's say you have here all the period expenses of August related to that period, no matter how many units you are selling of anything, of any product that you process, manufacture, sells, whatever, right? It only mean, right? In the only important meaning is that to be part of the period. So the depreciation of the machinery that is considered a fixed manufacturing overhead, it's going to be on the variable costing. Check that here we have emphasized on the variable costing, right? A period expense. Let's say it's the depreciation of the machinery of August instead of being included into the material, direct labor, variable manufacturing overhead to be part of the product cost. Okay, this is pretty much how the income statement looks like. You have some approaches of this one. This is what we used to do before this managerial course. This managerial course. So you have sales as always, diminished by cost of goods sold to get the gross margin. After that, you diminish the selling and administrative expenses, and then you reach the net operating income or loss if the number were negative. Under this format, you are dividing the cost and the expenses according to its function. Okay, this is pretty much what you have in the inventory, and when it's sold, it goes to the income statement as cost of goods sold, and this is how much do you spend, okay, on to give this that you produced and sold to the customer, right, by selling, and how much is the cost for managing the business. In the variable costing contribution format, you have, the sales couldn't vary. Yeah, it means if you have units sold times selling price per unit, always you reach the sales, right? After this, you have the variable expenses, no matter where they're coming from, right? So you have variable cost of goods sold and you have variable selling and administrative. We have done this before, only once, right? Like warming up this kind of income statement. Up to here, you have the total variable expenses. So subtracting the sales minus the total variable expenses, I mean this subtotal is pretty much optional, yeah? You reach their total contribution margin. And after the total contribution margin, you diminish the fixed expenses, and we usually divide it into fixed manufacturing overhead only to emphasize this number and to always have it visible, right? And the fixed selling and administrative expenses. Okay, for having a total of fixed expenses, this is optional as well. And to have at the end a net operating income or loss, right? You will see that this cost of goods sold is lower than this another cost of goods sold, right? Why is this different? Well, this is different because remember, under absorption costing, right? The cost per unit includes 4 items: direct material, direct labor, variable manufacturing overhead, and fixed manufacturing overhead. And under variable costing, you only include direct material, direct labor, and variable manufacturing overhead. If you are talking about the same amount of units sold, always under variable costing, the cost of goods sold, it's going to be lower. Okay, we have there some adjustment, but up to now, keep that idea in your mind. Okay, so how do I know if it's a period or product cost? Again, let me repeat this as many times as you need in order to leave it clear. Okay, in variable cost, fixed manufacturing overhead is considered period cost as selling and administrative expenses, but selling and administrative expenses are never ever treated as product cost. Regardless, the costing method is always a period cost. I mean, the selling and administrative expenses are always period cost, no matter if they are fixed or if they are variable. Always is a period cost, okay? For example, if we have a fixed expense of salary of the CFO of the company, no matter if it's the salary of August, September, October, is always a period cost. You never add to the cost of a product, right? The salary of the CEO of the company or the CFO of the company is always treated as a period cost. The sales commission, there are variable costs of selling, right? No matter how big they are, no matter that they are variable, they have the treatment of a period cost. I mean, is the sales commission of August, let's say, of September, let's say, but you never add a variable selling and administrative into the product cost. Remember that under variable you have 3 elements only for assessing the cost of a product, that is direct material, direct labor, and variable manufacturing overhead. Okay, no matter that you have another cost that is variable, you only can add 3 items for a product cost. Okay, in absorption costing, fixed manufacturing overhead are included as part of a product of work in process inventory or finished goods, and only when the products are sold, those costs, I mean the 4 costs altogether, flows through the cost of goods sold to the income statement, as we explained before in the diagram. Okay, but on absorption costing, we have that element called fixed manufacturing overhead. Maybe you remember, right, that we have a rate for assigning this fixed manufacturing overhead. So let me continue with this. We have then this fixed overhead absorption rate. We call it FOR, right? So how fixed overhead manufacturing expenses are included into the product cost using standard cost. Remember? Companies calculate in advance, that's pretty important word, right? How much should be charged to every single product based in budgeted production units as a cost and a cost driver unit. So remember, this is in advance. Okay, this is planning. This is in January the 1st or before, right? According to the budgeted production that I'm expecting from the next period. So how do I calculate my fixed overhead absorption rate or my FOR? I only take the fixed manufacturing overhead. Let's continue with our example. Let's think about the depreciation of the machinery. I only divide this by the budgeted production if we are talking about units, right? The ratio in here, the rate in here is going to be units of pesos or dollars per unit, okay? So this rate could be in units, machine hours, labor hours, or any other cost driver. Remember that the cost drivers is something that triggers a cost as well as you are using a resource in order to generate more units as the production, right? The activity level, remember? So, for example, we have an example. If we have as a cost driver units and our budgeted production is 250,000 units and your fixed manufacturing overhead, continue in your mind with those examples of depreciation of the machinery, right? Your fixed overhead absorption rate or FOR per unit, right? Because remember, if the denominator is unit, you reach dollars per unit or pesos per unit, okay? It's gonna be this amount of expense, that is 500,000 divided by 250,000 units. That rate is gonna be $2 per unit. You have to charge on that fourth element that we call the fixed manufacturing overhead in each product $2 per unit, okay? If your cost driver is machine hours, okay, you have again the budget production of 250,000 units. Your fixed manufacturing overhead is still $500,000, and your machine hour per product is 10. You are using 10 hours per product to be produced. So what are your budgeted machine hours? Is only assigned to 10 hours per unit, right? Times 250,000 units to reach that you will have 2.5 million hours, okay? So your fixed overhead absorption rate per what is this machine hours, right? It's gonna be 500,000 divided by 2.5 millions of machine hours. That is gonna be 0.2 per machine hour. But remember, you need 10 hours, right, per unit. So if you multiply these times 10, it means that you have again $2 per unit produced, okay? So how we calculate it? Why do we calculate these machine hours? Actually, we use pretty much this cost driver because sometimes, remember that always we start with one product, and when we move to multi-product, like the reality is, sometimes you have products that stay in the production line lower time than others, right? So this is a more fair way to assign a fixed manufacturing overhead using the time that one product is using in the manufacturing line or the production line, okay? What if real life is different? What if I didn't produce what I have planned in my budget? Remember that the fixed overhead absorption rate is calculated in advance, in January the 1st or before that date, in order to have this rate and assign in absorption costing, guys, in absorption costing to the products, that little part and the fourth part, that is the fixed manufacturing overhead. What happened if I didn't produce what I have planned in my budget? That is pretty common, right? You have to do one adjustment that we call the fixed overhead volume variance. This is, the name is giving you the idea that if you vary, right, the volume, you have to adjust this fixed overhead rate. Let's see how it works. Fixed overhead volume variance is the difference between the fixed production cost budgeted and the fixed production cost absorbed during the period. Remember, the fixed overhead absorption rate takes you to every product how much of the fixed expenses, of the fixed manufacturing overhead will absorb, right? That's why it's called absorption costing, as the fixed manufacturing overhead. The variance arises due to a change in the level of output attained in a period compared to the budget. Think about it. If you have different budgeted units, right, versus actual units, you want to have a different there using this rate, right? Or you over assign or overcharge some expenses, or you undercharge, right, those expenses of machinery depreciation. That is pretty much our example today. So if you were more efficient than you budgeted, that little rate of 4 could be adjusted to be lower. But remember that that 4 remains the same during the period. So you have to do that adjustment in order to decrease, right, all the charges that you have done in order to be, exact in the amount of fixed manufacturer overhead that you expend in 1 year. Remember, this is only on absorption costing. Remember that we are talking about that little part that is fixed manufacturing overhead. Okay, so it's adverse when you produce less, of course, because you were less efficient. Yeah, so you have an undercharge. And favorable when you produce more than budgeted. You overcharge your income statement, so you have to adjust back that number. Okay, here we have an example. Let's continue with our budgeted production of 250,000 hours times 10, that we have 2.5 million of hours of machinery, remember, right? Our actual production was 3 million instead. So we have a difference, right, in our favor, because producing more, right, means that I will be more efficient with my cost management, okay? But as I charged zero point 0.2 per every dollar, per every hour that I said, I have charged, right, this zero point 0.2 times 3 million hours. I sent to the inventory in every item sold, or to the cost of goods sold of every item sold, this fixed manufacturing overhead in zero point 0.2 each, right? Or to the inventory in the same rate. But if you multiply the actual production hours, that is 3 million, times 0.2, you will see that you send to the inventory or to the cost of goods sold 600,000 instead of 500,000 that was the expense of the year. So you have a favorable variance of 100,000. That means that you have to reduce in an adjustment your cost of goods sold in that amount, that is 100,000. Okay? In the other way around, when you have the same budgeted hour, that is 2.5 million hours, and you produced only 2.1 million hours, you have a difference to be inefficient, let's say, in 400 hours, right? So you charged to the inventory cost or to the cost of goods sold only these 2.1 million hours times 0.02. So if you do your calculation, you will see that you only took in there is 420, 420, right? Pesos or dollars, for 420 thousands of pesos and dollars. So you have adverse variance of 80,000. What it's the same, it's only declare the difference between what you have budgeted minus your actual production, and that difference times the 4 or the fixed overhead absorption rate in hours, you will see that you have an undercharge of 80,000. What do I have to do if I have adverse variance? I have to increase my cost of goods sold in this amount of 80,000. In the other way, when I have favorable variance, I will reduce my cost of goods sold in this amount. Remember, again, this is only on variable costing, okay? So we may infer that different costing methods will give you two different operating income in the same period, and you are totally correct. Depends on the inventories, believe it or not. So if you take the relation between the production and sales for the period, and you will see that you have an effect on inventories, and the relation between the absorption and variable cost in our net operating income is going to be explained as follows. If you produce the same amount of the units that you sold, you don't have any change of inventories. For example, I start my month or my year with 10 units in my inventory. I produce 100, I'm selling 100, so I have at the end at the same 10 units as the beginning, right? Because the one that I produced is added to the inventory, the one that I sold are diminished from the inventory, so at the end you have the same inventory, okay? It means that under absorption costing, the net operating income is going to be the same than variable costing in the net operating income. Why is that possible? Because the amount of fixed manufacturing overhead that you expend in this year or in this month, the period that you define, right, is sent totally to the cost of goods sold because you sold everything that you produced. Nothing is sent to the balance sheet because you didn't produce something. I mean, if you didn't produce or sell something, right? So you don't have any change of inventory. So if you think about it, think that the fixed manufacturing overhead stays in the same period, right? And remember, on variable costing, fixed manufacturing overhead is treated as a period cost. So you don't have any difference when this happened. But when you produce more than the units you are sold, you will increase your inventory because you are accumulating inventories. And when you accumulate inventories, you are sending this little part, this is the fixed manufacturing overhead, instead of the cost of goods sold, you are sending it to the inventory under absorption, right? And under variable, the fixed manufacturing overhead, remember, is treated as a period cost. So you send it directly to the income statement, so the net operating income is affected, right? But in absorption costing is not affected in that little piece that you send on your inventories increment, okay? In the other way around, when you produce less than the units sold, you have a decrease on inventory. And remember those inventories that you sent in the past, right? For gathering more merchandise uh, in your inventory, right? What happened when you produce less the units that you are selling? You decrease your inventories. I mean, you release some products from your initial inventory in order to fulfill all your needs about selling. What happened in that case? All the little amount that you have on every product of fixed manufacturing overhead now moves from inventory that is on the balance sheet to the cost of goods sold. Like in the opposite that in the past, right? And in this situation that you increase your inventory, you are you are deferring this cost to the future. In this specific case, you are releasing a cost that is moving from the past to the present, so the absorption costing was going to be a lower net operating income because you release more expenses than you expected in the past, and on variable cost in the net operating income is going to be higher. Okay, so exercising this with numbers in class is going to be better for this full understanding, but keep this idea. This slide is one of the most important to understand this topic, guys. How big is the difference between one method of the other one? It's not enough to know that if you have different methods, you will have different net operating income. No, you may know that the only difference depends in units, right, as we explained before, and this little part that is the fixed manufacturing overhead that was assigned to a product using the fixed overhead absorption rate or for as we use it as we name it in a shorter way. Okay, so the operation for calculating the profit difference is only declare, right, define the difference on inventory times the 4, right. Again, the net operating income is higher under absorption costing when inventories increase because fixed manufacturing overhead, that is this little 4 per unit, right. Remember that 4 might be using another driver. This is but is per unit, right. So it's higher under absorption costing when inventory increase because fixed manufacturing overhead is deferred to a future period, and net operating income is lower under absorption costing when inventories decrease because fixed manufacturing overhead is released from past period to the present, increasing the cost of goods sold. So again, remember again and again and again, under absorption costing, we have a box, let's say, a box of a product that travels with direct material, direct labor, variable manufacturing overhead, and fixed manufacturing overhead having a higher cost, right? In this case, the cost will be 54. And in variable costing, right, we have a smaller box, let's say, with the cost that travels from the inventory to the cost of goods sold only by using direct material, direct labor, and variable manufacturing overhead for reaching a lower unit cost. Okay, guys, so this is pretty much what we have learned today about costing method.